Morning friends, today we will be discussing the key sectors to buy in the current environment where we are witnessing huge changes in the economy on account of demonetization, key stocks to buy, key sectors to hold and key stocks to sell. So see what we have seen, and based on our extensive channel checks and research across sectors, we have been able to observe two, three phenomena. One is that most of the businesses in India, which is essentially the small scale businesses, are in a wait and watch mode about how things are going to unravel. So this has resulted in many factors. One is supply chain disruptions, and second is production cuts. So that is impacting companies and sectors across, which is also impacting both the demand and supply scenario. So in this scenario, what we need to hold and how we need to protect our portfolio is going to be one of the key factors. So while we believe that in the medium term we are going to see a lot of liquidity into the financial system, which will essentially seep into the financial markets, which will essentially mean the valuations will continue to hold, but the critical factor will be how will we protect the portfolio against the changes which are taking place in the economy at this point in time. What we are able to observe is that as we are saying, there are supply cuts, supply chain disruptions and production cuts across the sectors, but demand for certain essential items, let's say consumer staples, are pretty much coming back to normalized levels. So November was a month where we saw a decline in the sales for consumer staples, which is for companies like ITC and HUL. But demand has been normalizing since then, and January should be a month where it should be normal. So for consumer staples, I believe that these sectors should see normalization. We don't see huge impacts on earnings for FY18 for the consumer sector as we would be expecting for some of the other sectors. Apart from consumer sector, what we also like essentially are companies with strong order book or strong product pipeline. So one company which typically fits the bill is MARUTI. So MARUTI has a very strong product pipeline as well as order book because of the waiting period for its two products, which is Baleno and Brezza. So this is essentially having a rub-off effect on the whole Maruti portfolio, and very recently company also announced that they are keeping the production schedule for the next year intact. So that means the demand scenario for Maruti as a whole has remained unchanged. So that stock I think will continue to do reasonably well. Yen has also depreciated, so that is again going to aid to margins. So overall we believe that company which has strong order book will continue to do well. Maruti, as I said, fits the bill, and consumer staple companies which is ITC, Lever and Colgate typically fit the bill in the staples category where demand is going to be normalized from January onwards. Apart from the consumer staples and companies with strong order book, we like export oriented plays or products manufactured by companies which are determined by global pricing scenario, because we are seeing globally inflation coming back, where we believe in this scenario company like Tata Motors fits the bill because their products are primarily, company valuations are driven by Jaguar Land Rover. And secondly, we like the metal companies. Again, the reason for that is that metal prices have been quite stable, they are moving up, so that should provide a fillip to profitability for the metal companies. Apart from these two typical export oriented plays tend to remain in the pharmaceutical space. We know that there are some problems in the pharmaceutical space, but we still believe that in the pharmaceutical space, companies like Sun Pharma or Lupin are going to come out stronger in the whole drive. So we believe that these are the two companies which we can again look at accumulating. Apart from this, in the IT space overall, we do not have very constructive stance in this space because of the growth challenges, but we still feel that Infosys is one company which will continue to do well in this scenario also. So we are recommending buy. The companies where we are indicating are going to be challenges are going to be in the consumer discretionary space, where we could see challenges emanating. Apart from that, in the other aspects of the construction sector, we could see some challenges emerging. So these are the sectors where we are asking clients not to be to wait and watch for some more time. Probably after the budget, we could start taking a look at some of these sectors. Banking is another big sector where we are overall bullish over the longer term. In the medium term, we are looking at companies with big portfolios and large market share. So we are looking at companies like SBI and ICICI Bank at this juncture. So these are typically our top ideas. As just to summarize, in the consumer staple space, top ideas are ITC, Hindustan Unilever, and Colgate. In the consumer discretionary, where overall we don't have a positive stance, but we still like Maruti. Then we like the export plays, which includes Tata Motors, the pharmaceutical companies, which is Sun Pharma and Lupin, and in the and Tata Motors we like in that space. And the banking sector, we like companies with larger portfolios, which is essentially SBI and ICICI Bank. So these are our typical recommendations. Our recommendation is mostly to remain defensive in this current scenario, not to build a very aggressive portfolio, reduce beta from the portfolio. Apart from that, we are not very bullish on mid caps, where in this scenario where there could be a lot of challenges that the mid cap companies might see, typically building material companies, tiles and others. We are not very positive at this juncture. So we are asking our investors to avoid these spaces. So that's our play for the next 2 to 3 months. Happy investing, and wishing everybody a Merry Christmas and Happy New Year in advance. Thank you.